Thank you. Thank you very much for having me today. And I appreciate IAA's engagement on the issues that are important to its members and to the broader markets. And I'm honored to be able to speak with you today. I want to start by saying that the views I express are my own and may not reflect those of my fellow commissioners or the staff. What are those views? Well, as Karen said, I've now been on the commission for approximately 8 months, and in nearly every meeting I have, I'm asked the same question. What are my priorities for my time as commissioner? And obviously, I've thought a great deal about this. In fact, over the past 20 years, in private practice, on the staff of the commission, as an international instructor in financial regulation, and now as commissioner, my career is focused on the SEC and its mission, and I have considered and analyzed our role from each of these vantage points. And I don't have to tell you that a lot has changed in 20 years. We've seen the integration of the internet into securities markets, which has transformed the way that businesses raise capital. A boom in investment advisory businesses, including the introduction of robo-advisors, has brought many new first-time investors into the markets. A seismic shift in investor preferences toward passive investing has led to exponential growth in ETFs and index funds. Decimalization and computerization of the stock markets has transformed the way that people, and now also machines, buy and sell stocks. And of course, a devastating financial crisis caused us to step back and reorient much of the Commission's work toward addressing the kinds of risks that gave rise to market failures in the mid to late 2000s. And I, just as many of you, have experienced these pivotal changes in real time. And just to give you a little bit of context on the extent of the changes in my time at the Commission, when I first arrived, the Enforcement Division had this group of attorneys. It was literally a handful, maybe 3 or 4, in a back room that people called the Internet Group. And they were just trolling what we called the World Wide Web in case any fraud should happen over the internet. So a lot has changed in our space. But at the same time, as the adage goes, the more things change, the more they stay the same. Throughout these changes, I've come to conclude that the SEC is wise to focus its resources and its core mission to protect, serve, and empower investors. If we do this job well, everything else follows. Maintaining fair markets and facilitating capital formation follow as natural consequences of focusing on what investors need and expect from the SEC. And in that vein, I want to touch on 3 areas where we can and should do just that. Endeavor to protect, serve, and empower investors. While these concepts overlap, there are nuances to each, I think, that bear discussion. First, protection. Our investment advisor advertising rules are designed generally to protect investors from false and misleading marketing. Marketing materials provide useful information to investors as they select or retain an investment advisor, but given the complexity of his advisor's services, the rules must ensure that the materials are accurate, understandable, and provide sufficient information and context to make an informed decision. This is the first real update, as I know you know, to these rules since 1961. So I applaud Director Bloss and the Investment Management Division for this important effort. And in general, the proposal would modernize much of the existing framework for advertisements and, importantly, address the presentation of performance in a much more holistic fashion than the patchwork of staff guidance that we have out there right now. So I supported the proposal, and I think it represents a meaningful improvement over the existing framework. It includes protective measures designed to ensure that investors are not misled. It updates and modernizes to reflect the changing ways in which investors review information and receive information. And it requires, in certain contexts, specific information to facilitate more informed decision-making. So updating our rules in this manner by trying to meet investors where they are is wholly consistent with our mission to protect investors. But I'd like to drill down on just a couple of specifics with respect to this rule or this proposal. First, one area that I think merits significant thought and debate is the emphasis on a principles-based approach in certain areas. This creates flexibility, but that can come at the cost of certainty around compliance. And that's something I know that professionals in this room are rightly focused on. I know from my own prior experience as in-house counsel how difficult it can be to translate sometimes broad legal principles into answers, straightforward answers to everyday questions from the business side. For the most part, they need yes or no answers. And a risk-averse compliance professional may default to a conservative approach that unduly restricts the substance of an advertisement. If rules are too broad or vague, we may end up circumscribing conduct that we never intended to capture. Let's take, for example, the proposal's approach to whether a presentation of performance or specific investment advice is fair and balanced. I think we can all agree that either type of presentation should be fair and balanced, but is that guideline alone enough for you to apply that standard on a daily basis? Another example is the prohibition of testimonials that are reasonably likely to cause an untrue or misleading inference to be drawn. And again, does this provide sufficient guidance to support compliance? I know that there are concerns expressed by many about what is often referred to as regulation by enforcement. If the rules requirements are too vague, though, how can we ensure compliance without raising these sorts of concerns? And if it's not enforceable, responsible advisors, like the people in this room, may find themselves competing against advisors who use performance information that is not fair and balanced. So I believe that the current proposal may rely too heavily on high-level principles, which can certainly exacerbate this issue, but I would sincerely like to hear from the folks in this room and have you help us get that balance right. Second, I support the effort in the proposal to specifically engage with and receive input from investors and small investment advisors through the use of questionnaires. These groups may not have the ability or the resources to provide meaningful responses to the numerous requests for comment in these proposals. And the questionnaire approach, I think, provides the opportunity to respond to discrete questions that are relevant specifically to them. I would support refining this approach and the use of investor testing for future rulemakings. And I hope those of you in this room will encourage your clients to engage and help us protect investors and ensure that their voices are heard in our rulemaking process. Next, in addition to protecting investors, the Commission plays a vital role in serving investors. Serving investors' needs starts with listening to them, and investors have been clear about their need for climate risk disclosure. We must ensure that investors receive the material information that they need to pursue their investment goals, either on their own or through investment advisors. And as most of you know, the Commission continues apace with its Disclosure Effectiveness Initiative, which is an overhaul of the disclosure regime and requirements for public companies and funds, in an effort to improve and modernize that regime. Unfortunately, however, that modernization effort has thus far declined to address what has been called one of the defining challenges of the 21st century marketplace: climate change and its attendant risks. There's overwhelming investor demand for consistent, reliable, and comparable disclosure around climate risk. Demand that I know many of the people in this room hear daily from your clients. The lack of consistent, reliable, and comparable disclosure in this area undermines investors and investment professionals' abilities to evaluate the relevant risks when making investment decisions, and this undermines efficient capital allocation. There's a growing body of evidence that demonstrates the importance of this information and its relationship to financial performance. And that's why we're seeing some of the largest asset managers in the world join the chorus of voices affirming the critical importance of this information to the assessment of risk and long-term performance. And in response, most large public companies do supply some form of sustainability disclosure, much of it outside the reporting that's mandated by the SEC. But investors have been clear that the existing, largely voluntary disclosures are insufficient to meet their needs. Without even a standardized taxonomy, much less uniform disclosure requirements, Not all companies will disclose, and the disclosure will vary from company to company, meaning that it will lack the comparability necessary for meaningful investment analysis. So going forward, I personally will continue to advocate that the Commission address climate change risk through rulemakings and guidance in order to better serve investors. I hope the folks here today in this room will help us in those efforts as you continue to look out for your clients and respond to their needs. And finally, empowerment. Investors must be empowered to hold the stewards of their capital accountable for the decisions they make and the strategies they pursue. The proxy process provides the mechanism for this, and it's the Commission's role to ensure this process runs fairly and efficiently. Unfortunately, as Karen alluded in my view, each of the two proxy proposals released last November would operate to disempower investors. One of the proposals will, among other things, restrict the ability of certain shareholders to submit proposals for a vote at a company's annual meeting. Which shareholders? Only small retail investors, exactly those whose interests that the Commission otherwise purports to elevate. I have numerous additional concerns with that proposal, but I want to focus more today on the second of the two proposals because I know the one related to proxy advisors is one about which you all care very much. And you are not alone. The Commission has received hundreds of comment letters representing trillions of investor dollars on this proposal. There appears to be a strong consensus of opinion among those who rely on proxy advisors that the rule as proposed may be ill-advised and would operate to increase costs, reduce reliability, and potentially even reduce overall shareholder voting. I agree on each count. Let's start with what is conspicuously absent from the proposal. Real evidence of a real problem. The proposal rests on the premise that proxy advisor recommendations contain errors sufficient in number and scope to warrant a rulemaking. But no objective evidence is offered for this anywhere in the release. Instead, the proposal uncritically reproduces allegations of error. Allegations which, by the way, still show a very, very low error rate. But the proposal does nothing to examine the validity of the allegations, despite the fact that we have access to the relevant filings and we could and should do so. Examining the factual basis for these allegations is particularly important where they represent the primary policy justification of the proposal. The proposal also, not surprisingly, cites no evidence that investment advisors who use the services of proxy advisors have failed to uphold their fiduciary duties in voting proxies. And there's no evidence from exams cited in the rule of proxy advisors or investment advisors that could support the rulemaking. I've often heard the claim that you can't prove a negative, but it seems as though that is what we are expecting of proxy advisors. The burden ought not to be on them to prove a lack of evidence, but rather the Commission is required to set out a record to support its rulemakings with evidence. Next, the proposal proceeds to what I think is an even more implausible premise, and that is that these alleged errors would be reduced by mandating greater influence from a conflicted party, the issuer. This defies common sense and thus predictably runs counter to the approach we take in other areas, such as in protecting the independence of analyst research. As I've said before, issuers have deep expertise and insight on proxy ballot issues, but they also have a clear stake in the outcome. They can and do offer viewpoints when they disagree with a proxy advisor's recommendations or the factual bases underlying them, and those viewpoints are valuable. They belong in separate filings that investors and their advisors can evaluate and judge for themselves. And finally, and perhaps most importantly, the proposal presents risks to the exercise of shareholder voting rights. Most investors rely heavily on investment advisors and asset managers, like those of you here today, to vote on their behalf at annual meetings. And I know you take that responsibility seriously, and that many of you depend on proxy advisors to help you make informed decisions about how to cast your votes consistent with your clients' best interests. Because the proposal introduces costs, delays, and unreliability into the proxy process, advisors may feel compelled to abstain from voting altogether, thus stifling investor voices in corporate democracy. This outcome, a reduction of investor engagement with the companies they own, in my view, is clearly not in the best interest of investors. This is the opposite of investor empowerment. And that just brings me full circle to my original point, which is that in every endeavor we undertake at the SEC, we should focus on whether we are protecting, serving, and empowering investors. I appreciate the role that you all play in helping us do that every day. So thank you for having me, and I look forward to answering your questions.
I'm just going to stand up for a minute to ask some of the questions that we have. Let me start by saying you previously worked in the SEC's enforcement division, and with that background, what is your philosophy on the SEC's self-reporting initiative and self-reporting generally, and your enforcement philosophy more generally? In other words, you know, some folks talk about individuals versus company penalties.
Mm-hmm. Yeah. Am I mic'd up if I move away?
Yes.
Okay.
Yeah.
So self-reporting. So I have to say, having spent over a decade in enforcement, I think that is one of the best outcomes we can achieve in terms of deterrence, in terms of leveraging the kind of work that you all do every day. It has to be done right. But when you reward people for finding their own problems and coming to the SEC with them, I believe strongly, my personal view is there should be a lot of credit given when that occurs. And so it should be encouraged through lesser sanctions when that occurs. But we can achieve so much more with those types of efforts. And I think almost everyone would prefer to figure out for themselves if they have an issue and figure out how to deal with it than to have that phone call with the subpoena following up. It's more efficient. It's more collaborative. It helps, it helps us leverage the efforts of the hardworking compliance professionals like the ones in this room. But it has to be done carefully. So I take that part equally seriously. It should be structured carefully and thoughtfully, and with a view toward tailoring it when necessary to the specific circumstances of any given case. But I've seen those be very effective at changing market behavior and making it a more level playing field for the folks who are playing by the rules. With respect to kind of individual versus corporate liability, I don't view those two as in tension. They're complementary. My personal view, the goal at all times of enforcement is compliance. That's what we want. We just want compliance. And so, what's the best way, once it comes to the enforcement division, there's already been potentially a lack of compliance. So deterrence. Deterrence is how you achieve compliance. How do you achieve deterrence? In my view, personal liability. Now, that has to be in the right case. There has to be, but it's, to have a series of, over a series of time, kind of a drift toward only corporate accountability. Corporations are people. There are people in those corporations that are doing this. I think that we should be always carefully looking to see when there are individuals who may be responsible for some of the violations. I think that is a strong deterrence. But as always, we must be fair and thoughtful in that approach. So.
One of the questions we just got, what your views are on the SEC's efforts to reach more investment advisors through sweep exams or other similar exam approaches.
Well, this is a tough one because everyone knows that your field is just growing and our resources are not. And I think, I mean, I'd be interested to hear from you, but I think that the inspections can be helpful on both sides. We learn a lot when we go in. You learn a lot about our views. Most of the time, those are very collaborative. And I have, even as an enforcement lawyer, attended some of those. I hang back and try not to, because I really just want to see the interaction. And I've been amazed and impressed with how valuable I think that interaction is. So I do think kind of everything we can do to let folks know we're here, we want to help, we want to help you comply, we want to help you understand our view of what that means. I think that's better. But clearly in this area, we should be listening to you. So if you have thoughts about how we can do it best, how can we best figure out how to touch as many folks and help as many people get to the place where they feel comfortable that they're doing it the way we expect, and or that we've heard that maybe our expectations aren't right, the better. The more dialogue, in my view, the better.
Thank you. With respect to the SEC's proposal on derivatives, you supported the need for sales practice rules for the leveraged and inverse funds. Historically, advisors' duties, as you alluded to, are principles-based fiduciary duties rather than broker-dealer-like sales practice rules. Why do you see a need for special rules here, and do you anticipate extending this concept to other kinds of strategies or products?
Well, that's a good question. It's a proposal, and we'll hear from you all. We'll hear from the public on that. Here I do regard this as a little bit unique. So in terms of future, I can't say. That we'll have to take up on a case-by-case basis. But some of you may have seen, we just last week put out another huge case connected to the inappropriate sale of leveraged and inverse ETFs. To in a buy and hold situation that just doesn't make sense for almost any investor. So I do think that this particular area warrants greater attention, but I'll be interested to see what the commenting is, and if we will listen carefully, as we always do, to folks' views on that. But what I have seen, and it's usually the smaller retail investors. They don't understand. They know they like ETFs. They frequently do not understand if and how a leveraged ETF would really work, what the purpose of it is, and they lose a lot of money. So, maybe if you don't think we have that one right, if you think we need to dial it back, or if we need to make some adjustments, I'm certainly open to hearing about that. Y'all are the boots on the ground doing the work, so I would love to hear from you on it.
Oh, thank you. We've had a couple of questions with respect to the advertising rule following up your remarks. One of them is whether you anticipate more guidance with respect to some of the principles-based duties in the rules. Another is whether there is a path for narrowing the definition of advertising, given that it would cover almost any communication between an advisor and client or prospective client. How are we going to address the effect of the breadth of the definition?
So again, that's another one where I'm certainly, we are all open to hearing from you on that. I think that the definition should be broad in the first instance, in general, to make sure that we don't let unforeseen types of advertising kind of slip through. I think maybe when it comes to the types of communications you have with existing clients, that could be an area where we could look at and consider, is this a place where perhaps the definition could be altered, or could be, we could view it differently. And I'm open to other thoughts on that. I do think we have to make sure that in the first instance we've captured every possible type, but that does not mean that we then don't look for circumstances in which it's appropriate to tailor it. And then what was the first part of your question? Sorry about that, if I don't write things down.
Guidance. Whether there would be guidance.
Yeah,
right?
guidance. So on that piece, it depends on where we end up finalizing. If we do end up finalizing some of the broader kind of principles-based rules that we have in there, I would hope we would. I can't say whether, what the plan would be, but I would assume that folks in this room would want to see that. And I know if I were the one having to answer those questions day to day from my business folks, I would want more guidance. So I would hope we would.
Yeah, thank you. With respect to the accredited investor proposal, you've expressed concern that it is too expansive. You've noted that the SEC hasn't provided sufficient data to back up its proposal, and that contrary to prior recommendations, it didn't index the thresholds to inflation. Do you believe that wealth or income is an appropriate proxy for sophistication? What if an investor hires an investment advisor on a discretionary basis to make investments in their best interests? Obviously, in that situation, the investment advisor is standing in for the clients and acting as a fiduciary. So, would be interested in your views on accredited investor.
Well, I did lay them out pretty directly in my statement, but it's a subject worth discussion on an ongoing basis. And the question of whether wealth is a good proxy. So I think everyone agrees at every end of this debate that it's a wildly imperfect proxy for sophistication, or depending on how you want to view sophistication, sort of the ability to get the information that you need in order to make an informed decision. But it's a clear rule, and I think that is what many issuers, many in the kind of capital raising side of things like. It's a clear line. If I meet this, I'm good. I've never thought myself that it was potentially the best way to approach it. I supported the idea in the proposal that we made of including finance professionals as accredited investors. That makes sense to me. But what I didn't support was the idea that we were sort of ignoring the rest of the problem. We're sort of saying, look, here's this imperfect proxy. There are people that are being captured by this that shouldn't. We need to put them back in. I agree, but we sort of ignored the fact that there are lots of people who aren't being captured who should. And that's because of in my view, the sort of infirmity of using a wealth threshold at all. But we have it, and again, like I said, many in that area, many in the capital raising community support that. But I would submit that it might make sense to think about it in a more contextual way, like we did in the proposal on that one piece. To ignore the fact that 37 years, I think it is, have passed since we set those wealth thresholds, that's just rulemaking by accretion. We're just basically making a choice to expand. And I think if we do that, we need to do that advisedly, with data, with open eyes, with public input. So in terms of professionals, having an investment professional stand in, I see the wisdom of that. I have some concerns about it writ large, and whether it would work, and whether, in fact, we really ought to be looking for ways to expand access into these markets for retail investors, rather than, I think, potentially taking steps to make the public markets more attractive, so that there's more investment choice in that area. But I'm open to that, and I do understand the thrust of the wisdom for that.
Thank you. Well, unfortunately, I think we have run out of time. Everyone join me in thanking Commissioner Lee for her terrific remarks.